Hello everyone. I welcome you all in Boost Up Startup Finance. I am Muskan Bansal representing Make My Financials. As we have discussed in our earlier video, Make My Financials, led by CFA Rohit Garg with over 10 plus years of experience and CA Rishabh, who are responsible for providing advisory services, business process management services, and taxation services. Continuing with the discussion where we are left off in our earlier video, simple agreement for future equity. Zoro is really curious to learn about SAFE since it gives a clearer picture for analyzing the ownership structure. So let's summarize what is SAFE. A SAFE is a financial product where the investor typically invests money today but claims ownership later. The company stands to benefit from being able to utilize the funds right away without having its equity diluted. Additionally, the SAFE investors also benefits since they are guaranteed to get the principal amount along with the interest when it is converted into equity at some preferred value per share. So when they get converted, they are called as SAFE preferred shares. So the first topic of today's discussion is trigger event. What is trigger event? Trigger event is an event that triggers the conversion of SAFE into the capital stock of a company. Yes, we have studied that there is no maturity date for conversion. Therefore, we'll be studying the circumstances where the companies have to have those SAFEs converted. In other words, as I've just said, the company stands to benefit from being able to utilize the funds right away until these trigger events. So, the first is when the company calls more investors for the equity price rounds. Price rounds are the equity investments based on a negotiated valuation of a company from, say, venture capitalists or roll-up funding, where one entity tends to invest on a base of multiple retail investors. Next is when a company is getting acquired or is acquiring or is merging with some other company. The ownership structure tends to deviate, triggering the SAFE to convert. Third comes where the company is being converted into a public corporation so as to launch its shares for the general public at large for the very first time, which is known as launching an IPO or initial public offering. Last point is when the company, due to any reason, has to shut down or to dissolve. The company's dissolution brings its existence to an end and its name is struck off by the registrar of companies. Then the SAFE investors get converted on preference basis over the other equity investors, whom we call standard preferred stock. Now, sale preferred stock has the same rights, privileges, preferences, and obligations as the standard preferred stock, but the liquidation preference, conversion price, and dividend rate are calculated based on the value per share of the SAFE preferred stock, which we are going to look forward in the video. Heading forward to different versions of SAFE. Before that, these both cap and discounts are used to manage risk for the SAFE investor. A cap is used to protect against a potential increase in the price of the share. There is one more term related to the cap, a floor. Floor is used to protect against a potential decline in the price of the share. So these cap and floor and discounts are the key determinants which help the SAFE investor to gain preferential right over other equity investors. So we are going to read first version where we have a valuation cap but no discount. We'll study it with an example where suppose the company's pre-money valuation for the next equity round comes out to be 5 million. For ease of the calculation, we have decided on 5 million shares. Therefore, the value per share comes out to be $1. That is, the new equity investors have to invest in the company as per $1 per share. Now, the valuation cap. There has been some SAFE investor which has a pre-decided valuation cap of 3 million. So now we will decide the value per share as per the valuation cap. As per 3 million cap, 3 million valuation and 5 million shares. The value per share comes out to be $0.6 per share. Therefore, it means that the safe investor will be allotted number of shares as per $0.6 per share, not as per $1 per share. So, whenever the cap valuation is lesser than the pre-money valuation, then the value per share is calculated as per the cap valuation, not as per pre-money valuation. And there will be no change if the cap valuation is equal to or more than the pre-money valuation. Let's say if the pre-money valuation would have come to 2 million rather than 5 million, it would have come to the 2 million. Therefore, we'll be calculating the value per share is equals to 2 million divided by 5 million shares, which comes out to be lesser than if we calculate it with the valuation cap. Now, the second version where we are given the discount, the predetermined discount rate. Then, same question, same example, but no valuation cap, but a discount of 20%. Now, we'll be calculating the 20% discount on $1, which comes out to be $0.8 per share. So now the new investors will invest as per $1 per share, but the safe investor will be allotted number of shares as per 0.8 per share. Now, the third version where we have both predetermined valuation cap and the predetermined discount rate. Same example, given valuation of 3 million and a discount rate of 20%. We'll be calculating value per share as per both, as per discount also, which came out to be 0.8, and as per valuation cap also 3 million, which came out to be 0.6 per share. So now, which one to decide? Lesser of both. Will it be the safe investor will be allotted shares as per lesser of both of the values, that is either $0.8 per share or $0.6 per share. So we'll be going with the $0.6 per share, and the new investor is going to come and invest as per $1 per share. Now, the fourth version where we are given no cap, no discount, then how the safe will be converted into the shares. Now, there is a presence of MFN clause, which we can say most favored nation clause, which ensures that the safe investor receives the same terms as the best deal offered to any other investor in the future. This means that if any new investor tends to have better deal than the safe investor, then the safe investor has all the rights to grab that deal. So these are the 4 versions of safe, and we'll be calculating and we'll be analyzing the cap table, the complex cap table in our next video. So stay tuned for that, and thank you so much for watching.